Hi, good afternoon. I hope everybody enjoyed their lunch. We now have a session where we've got a couple of businesses who are going to be presenting to you. We'll be starting with Ricky from Tandem. So I'll just let Ricky go ahead.
Hi there, guys. Nice to meet you all. I've said hello to a few of you individually. Can I, first of all, I'm going to tell you a little bit about me. Hope to possibly inform, mainly entertain you for 15 minutes. But just love to get to know a little bit more who we've got in the room. In terms of, I mean, when I was chatting last night, I said there was quite a big LP representation, so people invest into private equity funds. Is there any, would you be willing to do a show of hands for LPs in the room, or is that intrusive? LPs? Okay, quite a decent number. And GPs, people actually run their own funds, a few of them. Advisors to the industry, oh, quite a lot of GPs as well. Okay, advisors, cool. So actually pretty good mix. In fact, more GPs than I thought. Okay, great. Well, yeah, my name's Ricky Knox. I'm CEO and founder of Tandem Bank. My background is actually, I started my career in venture capital, helping to set up something called MMC Ventures, which is now a sort of £250 million venture fund in the UK. Started out around the same time as Alex back there, who's now in charge of Octopus Ventures, which actually does something a little bit bigger than MMC at this stage. So my background is more from the sort of technology side, from the venture side. And I have spent, I've now built 6 businesses, 5 of which were in what is now called fintech. I'm a little bit of gray in the beard. It wasn't called fintech when I started. Well, fintech was really trading systems for banks. So, I have quite a lot of knowledge around. So my career started off in entrepreneurialism, actually building a telecoms business that was providing some of the first networks into Africa, and recycling some of the network hardware from Europe and the States. I then built a foreign exchange software business that I sold. I set up a small family office that I still participate in and run, called Hexagon Partners, and would then built from that, and with external capital, something called Small Financial Services, which is a remittance business, currently the 6th largest remittance business. That's what Western Union does, helps immigrants send money home. Which sort of transformed the back end of the technology stack in that area of financial services. Then went on to build Azimo, which was a sort of pure play end-to-end digital, again, a remittance business helping people send money home, primarily flows from the developed world to the developing world. Azimo is still growing. Actually, they're raising capital now, if anybody's excited about the sort of growth stage, about $10 million of revenue. And when I came out of that business, it's being run by one of my business partners, Michael Kent. I did the first thing that entrepreneurs do, which is I went and sat on the beach for a little while. And while I was on the beach, I started work on Tandem. So really what we were doing is looking at the financial services space more holistically, which we've been doing from an investment perspective at Hexagon for some time, and going sort of what's coming next in terms of disruption, what's coming next in terms of technology transformation across the financial services space. At the time, we'd seen an awful lot of action in transactional services, so be that TransferWise, Azimo on the consumer side, and a whole load of stuff happening right the way across the spectrum in terms of payments and disruption in that area. This is a slide was actually from McKinsey saying that sort of 25% of that sector has been influenced or taken over by startups and innovations. What we'd seen as well was in another part of the industry, lending, we were starting to see signs of disruption. As if there are any lenders, there were a few lenders in the room. Very, very small right now. The whole peer-to-peer thing, which was always a bit of a scam because it was never really peer-to-peer. It was a nice marketing piece. But those guys who didn't manage to get, who had illiquid, which those tend to be pretty illiquid markets, found that it was very difficult to grow a business and very quickly moved to hedge to peer and then on to bank to peer, which is where we are in the US for some of the big peer-to-peer lenders. But the interesting thing here is where the disruption that was occurring in payment services was largely through price. TransferWise is, cut the fees, don't charge anything to transfer money. Revolut's now taking that a stage further with negative net interest margin. What you'd seen in lending and financing was more disruption through origination. So actually, were these guys charging masses of money less in interest? Well, actually, interest is much less transparent. It's based on risk. Different people can get different lending rates. But what you'd seen actually in this second area was the fact that banks had not really adjusted to the fact that their customers were no longer walking to the branch to get lending, but instead were going online. And in the UK last year, 2016, online lending actually exceeded branch-based lending for the first time. So this isn't something that's sort of going to happen in the future, but it's something that's happening right now. Now, that's not to say that all of that digital lending was being done by non-bank institutions. Banks still hold a big chunk of that, but they have very clunky origination processes. They don't work very well. They've got to plumb back into some pretty old-fashioned infrastructure, and so they're having a bit of a challenge, and left a gap for some smart brands to muscle in there and pick up some of the lending. Now, as any bankers in the audience will tell you, they also weren't nearly as good at risk management as the banks, and therefore, as soon as we have a bit of a challenge in the credit markets, there may be some other challenges, because obviously growing a business in the credit business, it's very easy to grow if you just give anybody money. What's harder is getting it back. So I invested a little bit into this space quite cautiously. I have to say I'm out of the peer-to-peer space now. Don't have any investments in that area at all. I'm a little bit concerned about where it's going to go in the next few years. Some of the guys, I think, and Zopa is actually the first to announce it's actually going to become a bank, which is really interesting, and I think is a trend you may see with some of the bigger ones moving up the regulatory food chain, and looking to to actually have a banking license and fund themselves through deposits. But when I was looking at this, and then which is 4 years ago when we were first analyzing the market, there was actually very little going on in sort of mainstream retail banking. There was a couple of startups in the States which were doing what I now call veneer banking, which is trying to create a new interface, something called Simple, another one called Movin'. But really nobody was trying to attack the sort of core retail banking business around the world. That has now changed. You may or may not be aware there are sort of 4 digital challenger banks that have received a banking license in the UK. There are actually lots making moves in other places. The States is a bit harder to get a license. So there's a couple over there. There's one called Varo Money, which is backed by Warburg Pincus. There's another one. Well, there's quite another one called Chime. And over here, you've also got a rough, probably 30 or 40 non-licensed, non-banks that are trying to sort of do bits around and pretend they're banking interface. Most of them leveraging off some of the prepaid card technologies that came through 10 years ago or so. So into this. So apologies if I'm like teaching anybody to suck eggs. Is this maybe hands up? Is this boring so far? Hands up if this is boring. Okay. No, good. Excellent. Hands up if you knew all this already. Yeah, a few. Okay, good. So I'm not totally missing the mark here. But yeah, so I mean, I'm going to talk a tiny bit about Tandem now, but I'm actually going to focus on kind of what do I think's next in this particular part of the industry, and what's the vision that Tandem was built on. And happy to answer questions about, like, generally, should you be investing in fintech? Is it a good area? Are you interested? I obviously, as an investor as well as an entrepreneur, have some strong views on the subject. It's a little bit more perilous than some other areas in terms of investment, particularly because of the risk management aspect, which some startups, just don't do. So So what do I think? Why do we think retail banking was tough? And it's very interesting because I get the what's wrong with the faster horse answer an awful lot when I talk to bankers about what the future is going to be like. They go, even to consumers, my taxi driver regularly says, but there's nothing wrong with my bank, mate, which is an interesting perspective. Obviously, there's a lot of people who don't feel that way. But actually, maybe I'll do another little straw poll, which is, has anyone had a slightly frustrating experience with their banking partner in the last month? Hands up. Well, good. OK, so there's a little bit of an issue, not necessarily a massive issue, but there's a bit of an issue. From my point of view, and maybe I'm a bit spoiled, but I've got 2 different wealth bankers. They're both useless. I won't say what institutions they're from. They generally kind of come and try and waste my time and sell me a product without having actually calculated anything about the risk or return. And I find that incredibly irritating because they don't even know what Black-Scholes means. So I get, I'm quite frustrated, but that's at a slightly different end of the spectrum. The poor sods who actually can't add up, can't use a spreadsheet, don't actually have, an A in maths GCSE, are actually struggling a lot more and really, really, really poorly served by the banks at the moment. And I like to use the analogy of Spotify. So do any of you here use Spotify? Yeah, a lot of Spotify users. OK, pretty awesome Spotify. I use it very regularly. So I sometimes, so what I'm going to do here is kind of draw a bit of a parallel between where we were in the age of the CD and where we are now in banking. Banking is currently artificially productized. Okay, banking is a spectrum of credit to debit. You're either lending or you're borrowing, and various bits of security applied to that, and a whole piece of payments, which is how do I access and use my money, particularly in a digital world. But banking is fundamentally digital, like music is fundamentally digital. Music don't get a piece of a group of lads in an Irish pub, sort of producing these CDs. The music is produced by artists, but it's artificially was productized, and the 12 tracks that you got on one of these were dictated by the size of the storage media that you were putting it on. Equally, I'm not sure this is a good picture, but banking is productized. Why in the UK do we have current accounts and savings accounts? In other countries, they don't have any delta between that. A good banker would explain to you, but actually, I've got loads of cost over here in the current account, so of course I can't give you any interest. But from a customer perspective, why are those 2 different bloody accounts? Well, because you don't want me to save, you don't want to pay me any interest. What is it? What's the rationale for the pooling equilibria I have right now? And a lot of them, go back even to the age of the coffee shop here in the city of London in sort of 1800s, where the World Bank comes from a big bench that used to sit at the end of the coffee shop, and you find that often they actually have either that or they're generated by artificial constraints in computer systems that existed 20, 30 years ago. So actually, I give an example of unsecured loan. I mean, I won't poll you, but did anybody ever wake up thinking, I really need an unsecured personal loan? No. I suspect the answer is no. No, you get an unsecured personal loan, and fucking, it sounds awful, doesn't it? When you think about it, from a customer, like if you're trying to name an album or something, like you would never call it an unsecured personal loan. It sounds horrible, insecure, a bit scared about it. But this person wants to buy a car. They want to go out, they want to buy a new iPhone. They want to do something in their life, and it just happens that the bank titles giving them money to buy a car as an unsecured personal loan. Needless to say, at Tanner, we don't call it a non-unsecured personal loan. But the interesting thing is that artificial productization is going to break down. So we're gonna in 10 years' time, we won't be buying current accounts. We won't be buying savings accounts. We'll be being lent money, or we'll need some money. We might be putting some money aside. We might be paying interest on it. We might be putting security against some lending, but we won't be doing it in the way we do today. iTunes in the music industry sort of broke that down. Broke down the productization. Suddenly it was tracks, so you no longer needed to buy the album. There wasn't the constraint of media. They made it a hell of a lot easier to buy. You didn't have to go to the record store. I used to have a terrible time in record stores. You imagine you walk in and there's 5,000 small pieces of plastic with lots of names. I have no idea who the hell they are. And so I end up with a really bad album like Now 23 or something, which is like popular music from 1997. But I found that a very bewildering process, a lot of work put on the customer. I had to go to the store, I had to pull the thing off the shelf and out of the morass of other stuff. But the buying process was bloody awful. In Spotify, you'll note there isn't a buying process, really. I pay a subscription, and I access the world's music. Hang on, so does there need to be... So if we come over here, what's the buying process right now? Well, another interesting nomenclature piece, origination. I mean, I think you're all pretty familiar with origination. It's a private equity term as well. What the hell does origination mean? Like, I'm a customer. Like, you want me to originate a product? What does that mean? You're like, oh yeah, I want some money. Yes, please. But I don't want to originate anything, and particularly not if it involves filling in 20 pieces of paper and walking to one of your really horrendous bank branches, and then going and maybe, if I'm really lucky, being granted, approved for a product. If Apple turned around and said, hey, please fill in these 400 sheets of paper, and then I'm really sorry you weren't approved for your iPhone, sir. You'd be a bit pissed off, quite naturally, and so the whole concept of the current buying process in financial services is quite broken. And then in terms of usage, and again, even in the world of music, I used to struggle with my very limited CD collection. It's a bit embarrassing, but maybe 25 CDs. It was still hard to choose between the 25, and I got the one stuck in the music player for weeks on end. It was very dull. In fact, my entire third year of university, I think I just had one album that was played on repeat. But with Spotify, it solves it. It's like, hang on, I can follow my friend. And because I've got a friend called Nick, and Nick's really brilliant with music. And so I just follow Nick, and I listen to what Nick listened to last week. It's amazing. Or I can go, I kind of feel like jazz. I just want something over here. Well, I remember some artist called Ella Fitzgerald, and yes, I just want, radio like her. All of those patterns, which take the work out of my music life and facilitate the buying process. You think over here in your finances, I mean, even when I pull out my wallet and I go, which of these am I going to pay with? It's like, oh, this one's got 0.5% cash back, that one's got 1% cash back. Do they take Amex? There's a whole thinking process, a whole load of work you do when you pull your wallet out that you shouldn't need to be doing, because it's all very easy to calculate. And if you tapped your phone on the terminal, right now, today, with existing technology, no new stuff, it could determine which card was the best one for you to pay with, which Standard will do. But obviously, existing banks don't have much incentive to do that because you might have other stuff in it. Okay, noted. So basically, we believe that that the way that you do banking will change significantly in 10 years. We also believe that it's fairly unlikely the incumbent banks will be able to adjust. And the reason is because we believe that in terms of UX and UI, there is an advantage, which is banks are actually quite bad at developing software right now. They spend an awful lot of money on it, but they don't do a very good job. But that's like a 3-year advantage. I went to see Deutsche Bank's digital factory last week. Anybody work for Deutsche Bank? No, good. No, it was actually good. It was good. It was good, apart from the fact that it completely neglected user-centered design. Their app is basically the invention of the guy who used to run their mobile development shop. So it's a bit like using an Audi. It's very sleek and black, but it isn't really designed to be super easy to use. Data and artificial intelligence. So banks are notoriously bad at this. I sat next to a banker in a data session at the Bank of England, who was CTO for one of the large banks, who said, when asked sort of how long do you think it'll be before you can fully access and use all the data that you have on customers in terms of transactions, everything else. And he said, well, look, we're working on the project to transform our data estate. I said, how long is it going to take? He said, well, sort of muttered for a while and then said 5 to 7 years. And that's if they hit their project plan. So I think there's a real challenge here. That's not to say that that it won't happen, but we think there's a sort of 5 to 10 year lag there. And lastly, customer culture. Banks are very, very efficient machines, but they're not very efficient machines at listening to the customer. They don't have a culture that's built around actually delivering for customers. They have a culture that's built around delivering bonuses. So I think haven't really told you very much about Tandem here, and we're pretty much out of time. But why don't we see if anybody has any questions about fintech in general or Tandem if you're really interested.
I actually think we are quite short time. So what I think might be good if you're available in the next networking break and people can search you out because, brilliant.
Thank you very much, guys.
Thank you very much, Ricky. Thank you. So we have next up talking about opportunities with Compare Europe is Georgi. Presentation, there we go, and I will let you go ahead.
Fantastic. Is the mic working? Yeah. So in a truly globalized fashion, after Ricky, you have a Russian speaking. So, and as we all know, the Russians are not known for being entertainers. So I'm not even going to try. So I'm a CFO of Compare Europe Group. So what we believe they are one of the fastest growing financial marketplaces in Europe. And as a true banker, I have the proper, pretty much pitch over here, but I whiz through 7-8 minutes, and it's not going to be an IPO pitch like a lot of people in the private equity are used to. So for people in the UK, it's a very well-known fact what's the price comparison website model. Now, let me please just spend literally 30 seconds where it is. So what we do, we help people compare, select, buy, and manage subsequently financial products, insurance, and home services in our case. So as all you know, so once you go and try to buy tickets, for example, in hotels, you go to Expedia, and this is what we try to get. We try to get people to help with their financial needs to come to our platform and obviously be returning customers. So to no extent, we're inventors of this model. There are plenty of companies, as you can see over there, who are extremely successful. And the reasons are very simple. So this is a very scalable model. Everything can be done in the internet, so i.e. online. Now, it's also extremely profitable model, and I'll show you some of the examples with the EBITDA and cash generation around 40% of revenues. But it's a complementary model to the partners, so we're not competitors, and it's a clear value add. So I just said, so you all know Expedia, Opodo, and so forth. What we, however, spotted is in about 15 markets in Europe, there haven't been or hasn't been one company which would target this markets. And these markets are huge, so we believe the addressable market is around 3 to 15 or 13 billion euros, and that's what we're trying to do. So just 2-3 examples. It's completely subjective, so this is the companies I like. So ultimately, in the UK, we all know Money Supermarket, 40% EBITDA margin, 15 years in operation, actually more than that, still growing at around 15% top line, and actually right now paying a dividend of around 3-4%. Check24, which actually I believe we're the closest. It still is a private company, a phenomenal company in Germany, and Credit Karma, albeit a different business. The interesting point about that, and especially about the UK, it's not a winner-takes-it-all market. So as we know in the UK, right now there are 4 or 5 companies which take around 80-85% of the price comparison market, and they're all pretty much, so they maintain the same margins, and they grow at significant rates. So some of them maybe 5%, but the best in class up to 20%. So where we are. So we launched our company 2 years ago, and since then we grew, or we captured 5 markets. So these are Nordics, Norway, Finland, Denmark, and so Central, Western Europe, Belgium, and Portugal in Southwestern Europe. So there's a very sophisticated market, albeit slightly different dynamics from each of them. And I'll speak a bit more about what the size of opportunity over there. And potentially we're thinking that we can go to another 10 markets now. They're in the Central Eastern Europe. They're completely different. They're less sophisticated consumer. They're less rich, uncomparable to Nordics, for example. But all these companies, so all these countries actually, the 15 of them, the one factor which unites them is that there's no clear leader in price comparison over there. There are some incumbents, but still, and obviously we're not saying that in Finland or Norway you would need 4 or 5 companies like in the UK, but we believe that each of these markets for sure can accommodate 2-3 companies like us and allow significant growth. Just maybe some statistics, and again, so apologies, it's a bit of a busy graph, and over there, unfortunately something happened with the projector, but it's not the empty spaces over there. So we operate in markets where actually, as I said, they are extremely sophisticated. So especially if you move to the left-hand side of internet penetration. So Norway, almost 100% internet penetration. It's a proper connected customer, and people, the customers over there, users, they want to deal with internet now, so they don't want to go anymore to branches, to agents, and therefore the strong opportunities for us. As you can see right now, so CEG5, this is where we are. The addressable market for us is actually comparable to one of the largest markets in Europe, so be it Spain or Italy. However, and I think this is the key, so I'll get over there. So that small diamond over here shows the price comparison penetration in our markets. And if you take a look at a UK example, so in the UK, this year, around 80% of car insurance switches and actually renewals as well, they happen through the price comparison websites. 10 years ago, it was literally 2-3%. Similar situation in Germany, so more than 50% in car insurance. The same with non-life, so the statistics over there, it's mostly about home insurance. UK, 66%, Germany around 50%. None of these markets where we operate, the number is nowhere near. However, structurally, these markets are exactly actually in the same position, if not actually better developed than UK and Germany. So therefore, the market is there, and what we're trying to get, and so we're trying to be a first move advantage to some of them. So we actually, in Compare Europe, we hate the word the price comparison, because if we were just in comparison, we were just purely comparing the products and ultimately not capturing the rest of the chain. However, what we do, so we compare the market, and one of the competitive advantages of us actually, or how we try to sell ourselves, is that we show not only our providers, i.e. providers which we subscribe, but also those which don't work for us, because we want to make sure that the customer goes on our website and take a snapshot of the entire market. Then we help the customers with personalized recommendation. Now, let's say example from life. So we have a deal with Amex, and you can get the Amex Platinum. However, if you are, let's say, a Portuguese consumer and your average salary is 1,200 euros, the chances of being approved for Amex Platinum is literally zero. So there's no even point to show this option to these customers. And therefore, actually, there's a customized funnel. Now, standardized applications, that's another part which we realize a lot of our competitors are not capturing. So, for example, I did say that I like moneysupermarket.com. However, if you go to UK competitors, the loans, for example, if you want to get a mortgage, will be sent to the application of the banks. And sometimes, or quite often, the user experience actually is not that good. We have standardized applications, so therefore you fill in one application for all the banks, and this is where we try to help with the user experience as well. And ultimately managing. So managing, as you can see, we're showing this next, because ultimately we're still a new company, so we're pretty young, so 2 years old, but more and more recurring customers will be going to our portal and ultimately renewing their car insurance, let's say, with just a click apply button. So the products, again, I mentioned it's banking, insurance, and home services. Just two things. This is the products which customers constantly need or renew on a regular basis, but also where a significant set of providers. None of these markets are actually provided where you providers capture, let's say, so 3 or 4, and therefore there's a significant dependence. And importantly, actually, again, this is how we monetize, how we make money. So not only we receive commission on a sold or deals which already been signed, but ultimately we sell clicks, we sell applications. It all depends how we shake the hands with our providers, and all depends how they want. But we also monetize data through retention deals. So for example, we know if the customer, let's say with Barclays, wants to get a loan, let's say from HSBC, we actually can monetize this data as well, and needless to say, advertising as well. So obviously, we have competitors. However, and I think that's the most frequent question I've been asking. So how come, guys, so you're over there, and aren't you afraid of the same people, moneysupermarket.com or Go Compare, going, let's say, to your markets and capturing? The thing is, so first of all, for them, it's a significant diversion from the core market. And as I already said, their markets, so be it Germany or UK, are still growing at very healthy rates. Now, each of the markets is quite personalized. So there are different dynamics which cannot be replicated elsewhere, and I'll speak a bit more about that. And therefore, you need to have the local team, so ultimately to make sure that you capture the specificities of the market. And obviously, your relationship with the providers. Anytime you go to another market, you start from scratch. So the barriers are there, but it's also that there's a clear benefits of the first mover advantage. So we are part of the Compare Global Group, although we operate independently. Compare Global Group, in addition to our markets, is present at 8 more markets. So it's 7 markets in Asia and in Mexico, and growing in a few more a few more countries right now. And the biggest advantage of that is actually the connectivity with our colleagues in Asia or LATAM. So if something doesn't work in Asia and we see the similar market in Europe, it's very easy for us to replicate it right away rather than to go through the trial and error, let's say, to do it in Europe without talking to our colleagues and then to realize it's but it doesn't work, so, and then start from the scratch. So therefore, what we realized, the whole time from the product development to actually application is significantly shorter for us. And needless to say, from the financial standpoint, we actually benefit from sharing the same IT center and also benefiting, for example, if we launched a, let's say, broadband product in Singapore, it only takes us 2-3 weeks to launch it actually in our markets. We also were happy to raise Series A financing early this year. So you can see some of the investors who participate, ASMCO, TIL, SoftBank, and so was a good move for us. And our sister company in Asia just finished the Series B financing with Alibaba putting money, Goldman, and Worldbank. So another credential to the business model. So what's next for us? Ultimately, the model's still there. So the migration from offline to online still continuing. So huge addressable market, which is still not so in the markets where we operate, it's pretty much in the nascent stages. And now for us, ultimately, so existing verticals continue bringing the revenues. We didn't put some revenue numbers over there, didn't want to bother you, but ultimately it's the 20-30% growth every month. So new verticals are low-hanging fruit, and we still literally trying to capture offline advertisement. So, and getting the returning customers. So hopefully on the way to become the largest financial platform in Europe. Thank you.